Hello and welcome to this special webinar of IFRS 9 Financial Instruments and Related Standards. I am Ruchira Javadana from ACCA Sri Lanka office, handling employers and membership. And today we have the privilege of having a very special guest with us, a very special speaker. Since we are short of time, I'm going to introduce our speaker to you. He's Umasudan Subramaniam. He's a CFA, FRM, ACMA, MSc, and most importantly, he's a FCCA member. Umasudan Subramaniam is a management consultant. He's a corporate trainer and a lecturer with over 20 years of experience in lecturing and training in all areas of financial accounting. Umasudan has also worked in the commercial sector for over 20 years in various industries such as commercial banking, investment banking, and manufacturing. He held various senior management positions within the commercial spectrum, and Umasudan was part of the exam development team of FRM examinations held by GARP in USA. He was also part of CFA. So we are very privileged and very honored to have Umasudan with us today to take over this webinar and take this forward. Over to you, Umasudan.
Thank you, Ruchira Javadana. Thank you, Ruchira. One second. Thank you, Ruchira Javadana, once again for the introduction, and welcome everyone. And we are going to have a session on IFRS 9 and related accounting standards on financial instruments. Right? My name is Umasudan Subramaniam, and I'm a management consultant, corporate trainer, and a lecturer for ACCA, CFA, and other finance certification. So due to the time constraints, and I'm going to straight away go into today's agenda. Basically, we've got a large agenda today over the next 3 hours, and I'm going to tell you how these financial instrument accounting standards are very relevant in the current context. If you look at COVID-19 situation, I mean, due to the COVID-19, the importance of financial instruments as an accounting standard has significantly increased. If you look at around the globe, the financial market volatility has significantly increased, right? And financial markets have fallen significantly despite significant stimulus added by governments and central banks around the globe. And number two, if you look at financial institutions, they are seeing increase in non-performing loans due to erosion in asset quality caused by COVID-19 and the related slowdown. And therefore, I mean, the knowledge on financial instruments and impairment of financial assets becoming increasingly important in the current context. Last but not least, the LIBOR transition, which is currently taking place, right? Risk-free rates on major currencies are going to eventually replace LIBOR by December 2021. So that's going to be, that's an exposure draft published by International Accounting Standard Board. And there is a comment period up to May 25th. We are also going to touch base on that towards the latter part of the topic. And as you all know, that the standard is like kind of a very lengthy standard. I'm going to talk about very high points relating to each topic, and we are going to dive deep into the most important topics. As we said, the financial assets classification, which is very important due to the falling financial markets, and number two, impairment of financial assets, which becomes increasingly important due to the erosion on asset quality of financial services sector. Last but not least, the LIBOR transition. So these are the key things that I'm going to focus on. And one more announcement for all of you. I mean, there are already nearly 500 people on board, and it's happy to see the momentum. I'm really excited to have a very interactive session, and there is going to be a question and answer session at the end, where the last 20 minutes I'm planning to dedicate entirely to answer your questions. But you know, the happy news is that you can keep sending questions from the start of the session, and then I'm going to take them up during the last 20 minutes, right? Before we kick start, just one more administrative announcement. I'm planning to give a refreshment break in 1 hour and 20 minutes from now, and then we are going to go for a break for 20 minutes and then come back on time, and then we can focus on the remaining part of IFRS 9 and related accounting standards. So before going into various standards that we need to cover today, it's very important for all of us to understand what are financial instruments. Remember, financial instruments are instruments which gives rise to financial asset of one entity and financial liability of another entity. Meaning that if a company is issuing a bond, right, from the issuer's perspective, is trying to raise financing. So from the issuer's perspective, it's a financial liability for him. But for somebody who's investing into the bond, it becomes a financial asset. Again, if you look at it, think from an equity issuance. If a company wants to expand and they are going to go for an IPO, right, initial public share offering to the market. So from the investor's perspective, it's a financial asset. But remember, from the issuer's perspective, who's raising the financing, it becomes equity. And remember, equity is again part of your broader financial liability classification. If you understand the fundamental accounting equation, which becomes assets equals to liabilities, and the liabilities are split into equity and debt. Right, so having said that, I'm going to move on to the agenda today. So these are the list of accounting standards that we are going to look at. IAS 32, presentation of financial instruments, where the major emphasis is on splitting financial liabilities into debt and equity. And then I'm going to focus on IFRS 9, recognition and measurement. Of course, we need to touch base on IAS 39, which is currently replaced by IFRS 9. So it's easy for us to understand how things have changed from 39 to IFRS 9, and what is in the what was in the mind of accounting standard setters when they did that. And on IFRS 9, I'm going to focus mainly on impairment of financial assets. As I said, that topic has become increasingly popular after COVID-19, and also the classification on financial assets. But also on the hedge accounting, we are going to go in detail, especially on the LIBOR transition and the exposure draft currently in place. So that's going to be our key topic. We'll be spending more than half of our time talking about impairment of assets and hedge accounting. And I go light on disclosure standards, which are anyway there in the handouts, which is shared with you. You can go through them at any point in time. And then the last but not least, IFRS 13 fair value measurement, which talks about how fair value is determined. Right. So this is kind of the agenda for us today. So before going into IFRS 9, I'm going to touch base on IAS 32, financial instruments and presentations. Right. What are financial assets? Financial assets can be cash or a debt or an equity instrument of another entity, or a contractual rights to receive cash or a financial instrument from another entity. So meaning that if you are buying equity investment of another entity, or if you are buying a bond investment from another entity, which would mean that you are holding a financial asset, right? As I said, from the issuing party's perspective, it becomes a financial liability, right? But the focus on IAS 32 in today's session, remember, is to classify financial liabilities into two broad categories: financial liability and equity. So now we are going to start looking at how do we make such classification, right? It's very important. This slide is going to be very, very important. How do we classify equity and debt? There are criteria which is given here, which we are going to talk about. If you see the first question, is the distribution mandatory or discretionary? If you start looking at a loan which you have taken from a bank or a bond that you have issued, the interest that you are going to pay to the investors is mandatory. You have to anyway pay the interest, whether you make losses or gains, whether you have liquidity problems or not. The interest needs to be paid. So if the distribution is mandatory, it becomes a debt. But if the distribution is discretionary, meaning it's on the company, then it becomes equity. For example, if you talk about equity shares, where the dividend payment are a function of the company's profitability, management's growth aspirations, as well as the cash flow scenario. So all this, the company can decide in their general assembly if to pay dividend or how much dividends to pay, etc. So the dividend distribution is discretionary, meaning that it becomes equity. Is there a maturity or perpetual? Remember, if there is a maturity and there is a principal repayment at the maturity, generally it falls into the category of debt. But infinite instruments like such as perpetual bonds, they fall into the category of equity. But remember, there are limited circumstances in which they can also fall into the topic of debt. And then preference over other stakeholders when it comes to dividends, when it comes to dividend distributions, or when it comes to anything else, we need to look at the preference, like look at preference shareholders. This is one of the key confusion among various stakeholders. Preference shareholders, is that equity or debt? Remember, the preference shares are clearly going to be debt because there is a dividend payment which is mandatory and it's cumulative. If the dividend not paid in 1 year, it's going to get paid in another year. So that's another point that you need to look at. And so from that perspective, remember, preference shares are in fact debt, right? So
Masudan, can I just quickly, do you have a pair of headphones? The voice is really echoing.
okay, come again, can you?
Yeah, the voice is really echoing. Do you have headphones?
Yeah, I do.
Thank you.
Is it better? Yeah.
Way better. Secondly,
Right.
can you just reshare your screen?
Yeah. Okay. Can you see the screen now?
Yeah, clearly.
Okay. Are we live now?
Yeah, we can see your screen now. I can see your screen. Just need to play in the slideshow.
Okay.
Great.
Okay, super.
Thank you so much, sir.
All right. In case if there's anything, please interrupt. Yeah.
Sure. Thank you.
Right. So we have been actually talking about how do we categorize debt and equity based on criteria. So the last thing that we are going to look at is claims on liquidation, right? This is going to be a very important factor that you need to take into account when you say claims on liquidation. Is basically that at the time of a company is liquidating, right? So at liquidation, who's going to get priority? If you look at the general liquidation ranking, trade creditors,
Sir, we lost your sound. No, I cannot hear you. Yeah,
Is it
still
better?
can't hear you. Yeah,
Yeah.
so
Is it clear? Is it better?
yeah, it's better now.
Oh, okay, super. I think there was an issue on this. Okay. All right. Can you see my screen?
Sure, sure.
Yeah. So all good now.
Yep.
All right. So we are actually talking about how do we split financial liabilities into debt and equity, right? We spoke about whether the distribution is mandatory or discretionary. If it's mandatory, it's debt. If it is discretionary, if it is equity. And if there is a maturity, it is debt. And if it is perpetual, it is equity. And preference over stakeholders in times of paying dividends, meaning preference shares have a preference over receiving dividends over ordinary shareholders, meaning that they fall into the broad category of debt. And last, as I discussed, there is a claims on liquidation where secured loan and unsecured loans, almost all instruments, including preference shares, have a priority over equity shares at the time of liquidation. So we also look at that in classifying instruments into debt over equity. I mean, now the question is, why do you think this classification is becoming very, very important, right? Point number one, there is the increasing trend companies can issue financial instruments which actually look like an equity instrument, but they are in fact a debt. So why do companies do that? Because there is an increasing level of incentives for companies to increase the equity in the balance sheet and reduce the debt so that they can present a better picture to the various stakeholders. I mean, if you look at the blue box, which is given in the slide, I mean, the main intention, you want to reduce the gearing ratio, which can actually show up a better balance sheet position, reduce financial leverage to increase debt capacity. To avoid a breach in financial covenants and subsequent consequences of refinancing. Could also be a corporate governance issue where the board remuneration may be linked to gearing ratio. So this is why, remember, the classification of debt and equity becoming very important. So I'm going to move on to slide 7. Quickly, we are going to look at some of the instrument and we are going to see whether they are debt or equity. Redeemable debt. I mean, I'm sure most of you all can now answer a redeemable debt is in fact a debt. It's not an equity simply because there is a mandatory repayment of principal at maturity. There is a mandatory interest payment throughout the maturity period, and they have high seniority at liquidation. These factors actually necessitate redeemable debt to be classified as a debt, not an equity. Zero coupon bonds, an interesting question. Why it's an interesting question is because you do not pay any interest on these bonds. There are no coupon interest payments during the maturity period. However, remember, zero coupon bonds are in fact debt simply because these bonds are either issued at deep discount or they are redeemed at a significant premium. So remember, the premium paid at the maturity period, right, reflects the rolled over interest which is on the bond. So although you do not pay coupon, you either issue it at a discount and redeem it at par, or you issue it at par and redeem it at a big premium. That premium, remember, reflects the rolled over interest. Therefore, the zero coupon bonds must be classified as a debt. Perpetual debt, this is a very, very important topic because you see most banks and financial services sector issuing large amount of perpetual debt. They call them tier 1 notes. They actually qualify as capital for banks, and it's been structured in a manner that the interest payments on these perpetual bonds are discretionary. So when you say they are discretionary, they qualify as equity, and the dividend payments on such instrument will go through statement of changes in equity, not via income statement. But remember, if you talk about a perpetual bond with mandatory interest payment, they should be classified as a debt in all means. So there is an increasing trend in the region where the banks issue perpetual bond with discretionary distribution of interest, which qualify as additional tier 1 capital. As you may aware that banks have regulatory capital requirements, so this is one of the reasons why these type of instruments are becoming increasingly popular. And next point, employee share option schemes. These are options given to employees where they can convert their rights to buy equity shares in the future at a predetermined exercise price. So the option elements of this will be classified as equity. Ordinary shares, we know about it, the dividend payments are discretionary, no redemption on maturity, and this has the least priority upon liquidation. So remember, ordinary share issues are classified to equity shares. Then again, one more interesting stuff before we complete this portion, convertible bond issues. What are these convertible bond issues? These are bonds issued by an organization where the company pays coupon interest, but at the maturity period, the issuer has an option to either convert the bond into equity or pay cash. That can be puttable and callable. The option to decide can be with the issuer or with the investor. So what does the standard talk about it? IAS 32 says this got both components in it. There is an equity component, which is the value of the option, and there is a debt component, which is the value of debt. So the standard requires equity and debt components on a convertible bond to be split and shown separately in the balance sheet using effective interest rate of a straight bond with no convertible option. The last point, preference shares, we already discussed enough on that. They are part of debt capital because the dividend distribution is mandatory and cumulative, and they have high seniority upon liquidation. So that's very important. Understand this, the most important part of IAS 32, to split financial liability into debt and equity. Simply because of the reasons I mentioned, there is an increasing trend, companies trying to issue instrument which looks like equity, but if you look at the substance of the transaction, they are in fact debt. Remember, we focus on substance over legal form, which is probably the golden rule in accounting. We always look at the substance of a transaction than the legal form of it. That's the confusion on preference shares. In most jurisdictions, preference shares are classified as share capital. So since they are classified as a share capital, there is a conflict with the accounting standard. But we go by the substance of transactions, the risk and rewards, and the control factors surrounding that. Therefore, preference shares must be classified as debt. So the focus is debt versus equity, motivations behind companies doing that, and also understand how to do that, and you apply substance over legal form. All right, so having done IAS 32, I'm moving on to IFRS 9, financial instruments, recognition and measurement, right? So, I mean, if you look at classification of financial assets, in IAS 39 and IFRS 9, there is a significant difference. It always makes sense for us to first understand IAS 39 on the classification and then move on to IFRS 9. So you can really understand what actually changed, right? So as per IAS 39, there are 4 categories of financial assets. Right? Remember, when I talk about a financial assets, you can typically look at three things. Mostly, it's not an exhaustive list, but we are going to talk about either we are going to talk about debt, we are going to talk about bond investments, we are going to talk about equity investments, or we are going to talk about loans and receivables. So these are the three major things that we are going to talk about as part of financial assets. Now we look at the classification in IAS 39. Remember, IAS 39 had 4 classification of financial assets. The first one is held for trading, or you can say fair value through P&L. So what it is, these type of financial assets are held by an organization for the purpose of short-term profit taking. So what do we mean by short-term profit taking? These are held by the company for trading purposes, where the holding period can be as low as a day to a week to 2. I mean, there's going to be an increase in trading activities on this portfolio of the respective portfolio manager, right? Remember, so you classify financial instruments into held for trading when your objective of holding such instrument is purely short-term profit taking, right? So that's first, and then you need to understand how do we account for them. The initial measurement of all financial assets are at cost, the price that you pay to acquire them. However, remember, how do you measure them on a subsequent basis, right? Do we do an MTM exercise? What is an MTM exercise? Mark to market exercise. Are we going to fair value these financial assets? And if yes, where are you going to take the gain or losses on the fair value measurement? These are the 2 important criteria that you need to look at. So if you look at held for trading, yes, you do measure them at fair value, and MTM gains or losses, remember, should be taken to income statement, right? At the time of disposal, there is no doubt the gain or losses will come to the P&L as well, and dividend income, equity investments, and all of them, dividend income on equity investments and interest income on bonds will also be taken to income statement. The next question is, can bonds be part of held for trading? This is a question people often ask me. Equity investments, we understand there is a trading, but remember, bonds can also fall into trading if you are in an active bond market and your objective is trading on bonds. So bonds and equities can be classified as held for trading with MTM gain or losses into income statement. Moving on to available for sale. I mean, there is a thin line between held for trading and AFS. We call them AFS, available for sale. Here, remember, the intention is not short-term profit taking. However, you might sell them if need arises. So there is a difference between these two. The initial measurement, as is said, at cost, you still fair value them at regular intervals, but the MTM gain or losses on AFS will be routed through other comprehensive income. You call it in short form OCI. So you take it to the balance sheet via OCI, and it will be reflected as the AFS reserve or fair value reserve, which is a component of equity in the balance sheet. The dividend income and the equity dividend income of equity investments will be taken to income statement, and the interest income of bonds will go to P&L. Gain or losses on disposal will be taken to P&L, and you can recycle the gain or losses, unrealized gain or losses of mark-to-market exercise back to P&L at the time of disposal for bond investments. Right. Third, held to maturity investments. What do we mean by held to maturity investments? Remember, only bonds can fall into this category because there is no maturity period for equity investments. So when you say held to maturity bonds, what do we mean by this? If your portfolio manager is buying bond investments to receive contractual cash flows, meaning interest payments over the maturity period and principal repayment at maturity, and he has absolutely no intention to sell them before. Remember, the initial measurement will be at cost, and subsequently the bond will not be marked to market. There is no fair value exercise because fair value as a concept becomes will not become meaningful when you are talking about an HTM, because you are not going to sell them. You are anyway going to hold them over the maturity period, whether the price increases or not. So it's measured at amortized cost model based on effective interest rate. However, remember the interest income on the bond and gain or losses on disposal, if any, will be taken to income statement. One important thing to remember in HTM is that this is a key point in HTM. In IAS 39, if you ever sell one HTM bond in your investment portfolio, remember all the HTM of the entity will need to be reclassified into AFS. Why is that? Because it raises the intention of, it raises a question about the intention of the company to hold these bonds till maturity. So that's the rule in IAS 39. And moving on to the last one, loans and receivables. This is very, very common in a bank's balance sheet. I mean, if you look at a bank, the single largest assets that they have is loans. And if you look at a trading organization, which is, I mean, giving credit, you see receivables. So these are loans and receivables. They are again measured at amortized cost. The accounting treatment is similar to HTM on loans and receivables as well. So having said that, I'm moving on to the next slide, which is very important for us to understand the classification of IFRS 9 and how that is different from IAS 39. Right, there are again 4 classifications. Number 1, fair value through P&L. Number 2, fair value through OCI bonds, fair value through OCI equities, and the 4th one is amortized cost. If you look at it, there is a key difference in the classification. In IAS 39, the classification was based on the type of investments like AFS, HTM, but here if you look at it, the classification is made on accounting treatment. Fair value through P&L, fair value through OCI. So that's where the key difference starting to come in. Right. Number 1, fair value through P&L. What does it mean? In this case, these instruments are pretty much held for trading. You can think about it like held for trading in IAS 39. They need to be marked to market, and gain or losses on mark to market exercise should be taken to income statement. And then as usual, dividend and interest should be taken to P&L, including the disposal gain or losses at the recognition of these instruments. Okay, moving on to the second one, fair value through OCI bonds, right? Okay, before moving into that, I want to add one more point to fair value through P&L. This is available for equity, bonds, both. This is definitely available for both equity investments as well as bond investments of a company. But if you look at the second classification, fair value through OCI bonds, this is only restricted to bond investments. And this is very similar to AFS. AFS fair value model in IAS 39, where you take the mark-to-market gain or losses to OCI to a fair value reserve account, which is a component of equity through OCI. You only take the interest income and gain or loss on disposal into the income statement. And remember, at the time of disposal, any gain or losses in your fair value reserve in the balance sheet now need to be reclassified back to your income statement. So that is fair value through OCI bond. Now the question is, what is the big difference between fair value through OCI bonds in IFRS 9 and IAS 39? Simply, this classification is not available for equity investments. For equity investments, there is no straightforward OCI option in IFRS 9. This is to prevent companies hiding behind equity statement on their mark-to-market losses. So International Accounting Standard Board encourages companies to classify most of their equity investments into the first category, which is fair value through P&L, and should not use the OCI option for equity investments. However, if you look at the third point, fair value through OCI equities, which is kind of a very specific classification where a company tries to classify their equity investments as fair value through OCI, where all the gain or losses on the mark-to-market exercise need to be taken to OCI, including that of gain or losses on disposal. Remember, there is no classification of gain or losses back into the P&L at the time of disposal. So only thing that can go to P&L for these type of instruments in IFRS 9 is dividend income on such equity investments. Nothing else goes into the P&L. So IASB clearly discourages this classification unless you have a very specific private equity that you have, which you do not want to sell them. You probably keep them as a passive strategic investment. You probably will require to increase the stake. You intend to increase the stake and make it into an associate or subsidiary in the long term, then you could choose this option. Remember, this option is not reversible. It's an irrevocable option in the standard, meaning that if you classify equity investments into this category, you can never reclassify such gains into P&L, and you cannot reverse the choice. You have to continue to follow the choice on fair value through OCI. So that's a very important point you need to really understand here. And then the last one, amortized cost, which is similar to the amortized cost model in IAS 39, which is applicable to bond investments and loans. It is not going to be fair valued, and they are going to be kept at amortized cost model using effective interest rate, where interest income on the bonds and loans will be taken to income statement. And remember, disposal gain or losses will be taken to income statement. So that's pretty much from IAS 39 to IFRS 9. I would actually say if you ignore the fair value through OCI option for equities, because most instruments will not qualify through that route, and I also feel most companies do not choose that option because they will never be able to take their equity gains even at the time of disposal into the income statement. So if you remove that out, you have fairly three options: fair value through P&L, fair value through OCI bonds, and amortized cost. So from that perspective, the IFRS 9 kind of streamlined and simplified the classification in IFRS 9. All right, so the next point is very important. I mean, how do you make this classification? That's something very important, I would say. The classification needs to be made based on contractual cash flow test and business model test. Remember, this is something which is introduced into the standard in IFRS 9. There are two tests that needs to be made: contractual cash flow test and business model test. The first question is, what do you mean by a contractual cash flow test? Which means you need to evaluate if a financial asset is meeting the requirements stipulated by the standard for contractual cash flow test. If you look at an equity investments, they do not meet the contractual cash flow test because there is no mandatory dividend payments or principal repayments for equity investments. So they do not have contractual cash flows. They do not meet contractual cash flow test. If any instruments do not meet contractual cash flow test, remember, they need to be accounted at fair value. No amortized cost option can be allowed for instruments which do not meet contractual cash flow test. What about bonds? What about loans? They do meet contractual cash flows because there is a contractual cash flow. Contractual cash flow meaning there is a periodical interest payments and a principal repayment at the maturity. That's what we say. There is a contractual right to receive cash flows over the maturity period and also at the maturity, right? So anything that meets the contractual cash flow test will be subject to business model test. But anything that does not meet contractual cash flow test will need to be by default classified as fair value. Right. Going on to business model test, when you say business model test, an entity needs to evaluate what is their portfolio management strategy. And if the portfolio management strategy of bond investments is to receive contractual cash flows over the maturity period and receiving principal at maturity, then your objective of your portfolio manager is held to maturity. Then such investments can be classified as uh, amortized cost, right? Like HDM in IAS 39. Remember something very important, the standard says you need to perform this test not at security level. You need to do the test on a portfolio level, not even at an organization level, because a company can have sub portfolios and each portfolio with a different objective. You can have one sub portfolio with a bond for trading, which you can measure them at fair value through P&L. You can have a bond portfolio with less trading, more kind of AFS. You can take OCI route for them. You can have another portfolio of bonds, which you probably want to keep them until maturity, which you will measure it at amortized cost. So remember, everything depends on business model test, and the test needs to be followed at your portfolio level, not at company level, because companies can have multiple portfolios. Definitely not at individual security level in order to avoid window dressing that was prevalent in IAS 39. Right. Now, this is very relevant for the current context. If you look at IFRS 9, reclassification between fair value model to amortized cost. Can you do that? I mean, why do we say this is becoming very relevant in the current context? Due to the increase in financial market volatility and increase in losses on most stock exchanges, including bond prices and equity prices, are falling despite massive stimulus added by various central banks around the globe and governments. But still, the markets are falling and the volatility remains high. So it's a high time companies can start thinking, can we reclassify our fair value instruments into amortized cost in order to avoid the mark-to-market losses hitting your income statement or equity. But remember, the standard is very clear. They clearly say you can only change your classification of financial assets, right? Only change them if there is a permanent change in your asset allocation strategies. If you're a portfolio manager, you have changed on a strategically, on a permanent basis, you have decided, you have made a decision, you do not want to trade on bond, you don't want to sell them, you want to keep them until maturity. If the decision is permanent, the standard gives you the flexibility to change them. But remember, you cannot change fair value through OCI options on equity investment back into any other models, because as I said earlier, that's an irreversible option in the standard. Right, so that's basically important. The short-term slippages or temporary changes on your portfolio management objectives might not mean you can reclassify financial instruments. So applying that into the current crisis, if you think the current crisis is a temporary one, I would probably think any portfolio strategies that you are making in the short term, because maybe your portfolio manager want to stop trading because of the increased volatility, but it could actually resume back when the market brings back. I mean, you become normal, and then the trading activities will become normal. So in that point of time, you cannot do this classification unless you have made a well-informed decision to make a permanent change in your portfolio objectives. Right, then there is something on the transaction cost before we move on to the next topic. On the transaction cost, what I'm going to tell you is that on the transaction cost on amortized cost instruments, if you have a financial asset which is measured at amortized cost, the transaction cost that you incur on those bonds will need to be taken to balance sheet. It needs to be capitalized with the bond's value. Now, before getting into more, you need to understand what are transaction costs. These are the commission incurred or any non-refundable taxes that you pay or any legal fees that you incur on purchasing these investments. They are called transaction costs that can be capitalized with the bond values or financial assets value if those instruments are measured at amortized cost. But the second one, if you are measuring your assets, financial assets at fair value, gain or losses, and transaction cost needs to be taken to income statement. So transaction cost related to instrument measured at fair value will go through income statement, except equity investment measured at fair value through OCI, where everything related to that instrument needs to go through OCI, including the transaction cost. To simplify, three things. Transaction cost related to amortized cost financial assets needs to go to balance sheet with the assets value. It gets capitalized. Number two, transaction cost related to fair value financial assets will go to P&L. Third, the exceptional thing, if you measure something at fair value and take it through OCI line, equity investment irreversible option, where the transaction cost needs to go through OCI, because except dividend income on these instruments, everything goes on to your incomes, everything goes on to your OCI. So that's kind of the reclassification between fair value model and amortized cost and transaction cost. And then we are actually now going to talk about recognition and de-recognition of financial assets. I mean, we have looked at IAS 39 classification, IFRS 9 classification, and what changed, and so many factors which are important relating to the current context. Now, before we going into the next topic, we will need to talk about recognition and de-recognition of financial assets. So what do we mean by recognition? Is the very first time you are recognizing a financial asset of your bond. You recognize them at cost. But when can you recognize? You recognize them when you have the contractual rights to receive the cash flows or any other financial assets, right? If you are purchasing a bond, purchasing an equity investment, the date of purchase becomes the date of recognition, unless the substance says otherwise. When do de-recognition occur? Remember, the de-recognition occurs when the contractual rights to receive cash flows expire. So when it comes to a loan, when the loan is fully settled, when it comes to a bond, the bond is matured, right? So there is no contractual obligation anymore. So these are the situations on which financial assets get de-recognized. Very important point. I'm sure most of you all should be able to answer this question. I mean, what is the question? Gain or loss arising on de-recognition of all the instruments needs to be taken to income statement. But remember, there is one exception to the rule, right? At de-recognition, all the gain or losses on disposal must be taken to P&L, except for equity investments classified as fair value through OCI, for which even the disposal gain or losses needs to be part of OCI. And as I said, only a passive private equity investment that you have, which you would probably want to progressively increase the stake in the future and make it into an associate where you use equity method of accounting, or make it a subsidiary where you use a line by line full consolidation method. Only for such instruments at the moment you follow and a fair value through OCI option if you have a plan to do that. Right. So, I mean, before we move on to the next topic, I want something to be very clear to you guys, is that in this particular standard, we are talking about financial assets with less than 20% stake. Right. This is the scope of that standards, whether you talk about bonds or equities. I mean, mainly this is applicable for equities. If you have, let's say, 25% equity stake in another company, then you follow equity method of accounting. And if you have more than 50%, you follow full consolidation approach. So we only talk about these classifications for financial instrument investments with less than 20% minority stake. So something that you need to keep that in your mind. That's the end of financial assets for you. We have completed a major portion of today's discussion, and we have still a lot more interesting stuff yet to come. So I mean, I'm now going to talk about recognition and measurement of financial liabilities. Right. What is a financial liability? As I said earlier, there is a contractual obligation to repay cash, or you repay another financial asset. That's when you recognize a liability in your balance sheet. Meaning that if you are taking a bank loan, or if you are issuing a bond, the date of bond issuance becomes the date of recognition of financial liabilities. The next thing is, when do you de-recognize financial liabilities? Right. Most importantly, remember something, the standard uses a specific word for de-recognition of financial liabilities. They say extinguishment of financial liabilities. Right. So when a financial liability is de-recognized or extinguished, number one, the liability is fully settled. Let's say you have taken a bank loan, now you have fully settled, or you have issued a bond which is now fully repaid. Or remember, the second one is very important. You are doing a substantial modification to the existing terms and conditions of the liability, meaning there is a significant revision on the interest rates or the term structure of your bond or loans, or change in covenants. These factors would mean that substantial modifications have taken place, meaning such instruments, such liabilities needs to be de-recognized, and a new liability needs to be recognized if the modification criteria is met. Look at what is the modification criteria. You establish the present value of the existing liability with the existing terms, and step 2, you calculate the financial liability with the new terms. You calculate the present value based on the cash flows and compare them. If the difference is 10% or more, you conclude that there is a significant modification, and you go for a recognition of the existing liability, recognition of new one with gain or losses taken to income statement. Also remember, when you are exchanging one liability with another, you would de-recognize the one that you have exchanged and recognize the one that you have received. So that's the recognition and de-recognition of financial liabilities. Now it's going to get more interesting. I mean, this is a least popular topic in IFRS 9, because everybody talks about AFS or fair value through held for trading, HTM. I mean, those categories are very popular, but remember, measurement of financial liabilities is less popular in the world of accounting. So it's worth spending some time on that. Even I mean, the COVID-19, remember, has a significant impact on this particular aspect of IFRS 9, the measurement of financial liabilities. Right now, if you look at IAS 39, they only had amortized cost model available for financial liabilities. You never have had a fair value model available for financial liabilities. The simple thing is, I mean, a company who's issuing a bond or a company who's issuing a bond will not probably trade on them. So it's not, they raise financing, they are going to repay the interest and principal over the maturity period. So the argument of IAS 39 was you account for these instruments at amortized cost. Right. However, it created a significant accounting mismatch between assets and liabilities between one balance sheet and another balance sheet of different entities. Number one, there are also different accounting treatment between assets and liabilities in one company's own balance sheet. I can give you an example. Number one, if you are issuing a bond, right, and taking the proceeds and buying investment properties. Now, this is where the most interesting thing coming up. You are issuing a bond and receiving the proceeds, and proceeds are getting reinvested into an investment property, which is measured at fair value as per IAS 40 guidelines, gain or losses on the fair value taken to income statement. So if you look at it, the bond that you have issued is a financial liability in your balance sheet, which you will probably choose amortized cost model. And in your own balance sheet, you have an asset, which is investment property, a non-current asset, which is measured at fair value. So you have an asset and a related liability. Liability is measured at amortized cost, which is the funding was used to purchase investment property, which is measured at fair value. So it's creating a large mismatch between assets and liabilities, and that's why the fair value option for financial model for financial liabilities was introduced. So as per IFRS 9, remember, you have two options. You can either choose to measure your liabilities at amortized cost or classify them under fair value model, right? So if you are classifying them under fair value model, now the question is, do you do a mark to market? Yes, you do a mark to market. Where do you take the mark to market gain or losses? If you ask me to answer this question in simple one word, I will say P&L. You take the gain or losses into P&L. But remember, there is one more thing that you need to understand before you advise somebody on the accounting treatment, which is very relevant to the current context. If you see, most of the corporate bonds have fallen in value due to increase in credit spread for companies, right? For these corporate bonds have actually fallen down in value. So now what's going to happen to these type of financial liabilities from the issuer's perspective? Think from the issuer's perspective, because we do not have a problem with the investor's perspective. Why? If you have invested money in bonds and the bond prices have fallen, you will have to recognize a loss either in your P&L or OCI, which makes perfect sense. Why? The credit quality of the bonds have dropped, the fair value dropped, you have losses coming and hitting your P&L from an investor's perspective. Think from the issuer's perspective. Think from a financial liability perspective. Your own credit quality has deteriorated, your bond value has fallen, but you are taking a gain into your income statement. Why? If the liability is dropping, you debit the liability and you credit your income statement. So you're going to have an income coming in due to the fall in your own credit risk, which logically doesn't make sense. So that's why, I mean, even if you go back and look at 2009 financial crisis, this was a key issue. I mean, if this fair value model was introduced at that point in time, so many companies could have actually taken a gain on their own reduction on their own bonds in the market, and that is going to be contrary or create an offsetting effect to their losses coming from their underlying operations, because their numbers are bad. The same thing is applicable now due to the lockdown and COVID-19. Revenues have compressed and cost structures have remained rigid. So these companies are actually making losses, but if you allow these gains on the liabilities to be on the P&L, it will offset some of the losses. So it might not give the correct pictures to the users. So the bottom line is, if the fair value of your financial liability is changing, you split the change into two types. The change on your financial liability resulting from your own credit risk, and change in your fair value of your financial liability caused by anything else like market factors, interest rates, etc., etc. So anything coming from your own credit risk needs to be taken to OCI. However, if any other changes in the fair value of your financial liabilities can go to income statement. However, before making such a choice, you need to focus on the asset liability mismatch. Remember, this is something IASB is trying to eradicate in many accounting standards. I mean, if you look at it in the world of accounting, prudence has been a major accounting standard in the past, meaning we treat assets differently, liabilities differently. There is an accounting conservatism, right? We treat liabilities, we recognize them when it is probable, but we do not recognize assets until it becomes certain. So there's a difference of accounting treatment, which is over a period of time. Accounting Standard Board is giving reduced importance to prudence as an accounting concept, and they are trying to align the assets accounting treatment to the liability accounting statement. That raises a big question: is conservative accounting bad? Yes, it is. Conservative accounting is still bad. I mean, you need to present your results as it is, not aggressive, not conservative. So that's what is coming out from fair value model on financial liability. This is a very, as I said, less discussed topic in accounting. So that's the end of financial liabilities. So we are done with IFRS 9 classification and measurement of financial assets as well as financial liabilities. So now I'm going to go for a break in 20 minutes from now, because it's almost 1 hour since we started the session. So I'm going to go for a break in 20 minutes, and before that we are going to focus on one more accounting standard, IFRS 13 fair value measurement. So meaning that when we are back after the break, right, we have two important things to discuss. One is impairment of financial assets, and then hedge accounting and LIBOR transition. So we are going to leave the second half of the session only for them and focus on the next 20 minutes on fair value measurement. And if we finish this early, I will even go into financial impairment of financial assets even before the break, right? So IFRS 13 fair value measurement, this standard, I mean, is very, very important, not from just financial instruments perspective, from all the standards perspective. Why? Because I mean, we talk about the concept of fair value, or you call it market value, in almost all accounting standards, starting from non-current assets, investment properties, PPE, everywhere we use the term fair value. So it's very important to understand the definition of fair value, what is fair value, how to measure them, and what are the guidelines in IFRS 13. It's very, very important. So IFRS 13 replaced the old definition of fair value, and the new definition is that the price that you would receive to sell an asset, or the amount that you would paid to settle a liability between market participants in an orderly transaction at the measurement date. Now the question is, the important point is orderly transaction, what it is, right? Remember, when two parties are transacting, one is trying to sell an asset, the other party is trying to buy. Now you need to assess if the transaction is an orderly transaction. Remember, an orderly transaction is also a transaction between unknown, willing, and knowledgeable parties. It cannot be an arm's length transaction. If it is an arm's length transaction, the transaction between family members or related parties may not reflect the true fair value. So remember, true fair values or true market values needs to be considered in the measurement of fair value. Remember, this is very important. The best example that I can think about a bank trying to liquidate their collaterals or securities in the event of a default by a customer, where they are trying to liquidating their collaterals that they have pledged when taken the loan. So at the time of disposal, there is a for sale value for these assets at the time of liquidation. So this for sale value of these collaterals or assets is not fair value simply because they are for sale value. For sale value means they are the values in which if you want to sell your assets overnight in a rush, so they may not constitute the true fair value. So they may not constitute an orderly transaction at the measurement date. So remember, when you are looking at fair value, look at the term from holistic perspective, meaning that you need to assess if it does reflect the true fair value or market value of the asset that you are talking about. Now, remember, IFRS 13 classify fair value assets, whatever the assets that you measure at fair value, into three categories: level 1, level 2, and level 3. How such classification is made, remember, depending on the inputs used to measure the fair value. What are the inputs you are using to calculate and determine the fair value and recognize them in the balance sheet? Based on the methodology used in the determination of the fair value, we classify these assets into level 1, level 2, level 3. So that's very important. What is this hierarchy? This hierarchy is based on how you calculate the fair value. So moving on to the hierarchy itself, this is a very interesting slide and a very important disclosure companies need to make on their fair value assets. Right? Any assets that they are fair valuing, they need to split them into level 1, level 2, level 3. Why? Remember, how you determine the fair value have a great influence on the reliability of such numbers. You will get the picture at the end of the discussion. What is level 1 category in IFRS 13? In which the fair value is measured based on observable market data and also based on quoted prices in active markets for identical assets and liabilities. Let's say if you have Microsoft shares in your balance sheet and you want to do a mark to market on that, and you go to the stock exchange and take the prices and then you do a mark to market. So meaning, I would agree with you, it's a level 1 input because you are going to take the quoted prices in active market. What is an active market? An active market is a market with there are plenty of trading taking place between buyers and sellers with minimal transaction cost. So in such markets, the fair values in most cases represent the true market value of the assets. So if you are depending on quoted prices unadjusted in active markets for identical assets, I mean, if you are measuring Microsoft, you are taking the share price of Microsoft in the stock market. You are not using a proxy to value them. So it's a level 1 input, high quality input to measure your fair value, right? as you go down the line in your fair value hierarchy, the quality of the fair value measurement and their reliability gets compromised. Number two, level two. Still, level two is based on observable market data, but remember, the market that you are talking about may not be active. So you are taking the share prices of your bonds or equity investments in a market which is an inactive market, or you are going to an active market where you cannot find an identical security. However, you are measuring using a proxy to measure your financial asset. Meaning, again, it's, compared to level one, it is of low quality, however, better than level three, because still it is based on observable market data. And going into the last one, level three, you got to pay attention now on the level three. Why level three is becoming very important. Remember, in level three, the fair value is determined based on unobservable market data, meaning that you are measuring this instrument using your internal models. Maybe you are using discounted cash flow techniques or various internal models to value these instruments. And remember, you are not measuring them using observable market data, meaning there is subjectivity involved. The fair value that you determine involve various assumptions such as discount rate, your growth projections in your discounted cash flow techniques. Therefore, level three valuations are usually of less reliable in terms of your fair value hierarchy. Therefore, it is the standard clearly says, when you are looking at level one, level two, level three, you need to try and make use of level one for most of your investments. If that is not possible, go to level two, and they discourage you to use from using level three inputs in measuring the fair value of your financial assets or investment properties, because that will be the reliability of such measurement is a big question mark. So these are the best practices that you need to consider in the determination of fair value. The company always must try to use level one and level two observable input. Level three must only be used if level one and two is not available, right? Because as I said, level three is not preferable due to the subjectivity involved, right? Now, from an analytical perspective, right, what can it mean to a credit analyst or somebody working for a bank, or somebody is like kind of a fixed income sell side analyst? What it means, this hierarchy is very important, because you can come up with a composition of your fair value hierarchy and see what percentage of your assets are measured at level one using level two or three inputs. If you feel the company is making use of most of their investments using level two or level three, and only a smaller portion is measured at level one, I would significantly adjust the company valuation downwards if I'm a credit analyst, because the reliability of such fair value figures may be biased. So you probably need to take a haircut on that before you moving on forward. So that's why I say it's very important that you look at fair value hierarchy and make adjustments in your financial statements. If you are doing forensic accounting or you are a credit analyst, this is something that you need to focus on. Right, so that's the end of IFRS 13 fair value measurement. We just got 5 minutes before the break, so I'm going to give you a quick introduction on why this portion is very interesting, exciting, and very relevant at this point in time. Right? In financial instruments, we are talking about impairment of financial assets. We are going to mainly talk about bond investments, loans, and receivables. Why? Because most of the equity investment and bond investments which are measured at fair value are anyway at fair value. So our concern is about investments which are measured at amortized cost. So what can be measured at amortized cost? It can be bonds, it can be loans, or it can be receivables, right? So these type of three instruments, if you look at it, right, at any point in time, maybe the value that you can recover from those assets may be significantly lower than what you have stated in your balance sheet. So COVID-19 is an impairment indicator. It's a trigger event which suggests that the credit quality of most financial assets have dropped. If you start thinking about banking sector, what's happening to banking sector, it's a snowball impact on banking sector. Why? Because aviation, hospitality, the entire travel industry, restaurants, bars, I mean, so many sectors are adversely affected. And they are actually the borrowers of this financial services industry. So meaning if these industries are actually suffering, that's going to have a snowball impact on banks and financial services sector. So what's going to happen? People are going to find it difficult to repay the loans, etc., to back to the bank, and there's going to be an increased default rates and increased level of provisioning that the companies needs to take in their income statement and balance sheet as per IFRS 9. And most importantly, International Accounting Standard Board has given specific guidelines on how the expected credit losses needs to be treated in the financial statement. So there's a specific guideline in the backdrop of uncertainties caused by COVID-19. There is a statement issued by IASB in March 2020. We are going to look at that and how that's going to impact financial assets and their related impairments just after the break. So, I mean, we will go for break now and roughly in about 10 to 12 minutes, and we are going to be back and we are going to focus on dive more deep into impairment, and then last but not least on the hedge accounting. Main focus is going to be on the LIBOR transition, right? So if you have, thanks for being there, and please keep sending me your questions. I will try and answer as much as possible at the end. And if I do not answer your questions due to time limitations, right? I mean, and you can go through the slides and find answers, or you can go through any other accounting materials. But also remember, if you don't find the answer that you are looking for, or if you are still confused, please write to me in an email. My email address is given at the end of the presentation slides. So you can email me if you have a difficult question that you find difficulty in answering from other sources. So I'm going to be back in roughly about 10 minutes, and I'm going to mute the broadcast for the time being, and then we are going to get back to you shortly. Have a good break, and I'll see you soon.
Hi, this is Haroon. Let me show myself. Thank you very much, Masudan. Excellent session so far, and I can tell you there's a lot of interest from members in attending this session. I am Haroon Ahmed Jan. I am the regional head of member.
How are you?
Perfect. Thank you very much. Thank you.
Yeah.
I am the regional head of member affairs. There's some very important announcements. I took that opportunity when you announced the break. I thought I'll let the members know also. So a few announcements for members, and that is that ACCA has very recently made a special offer in its CPD offerings to its members across the world. So all the ACCA offerings, CPD offerings, are going to be free of cost. So ACCA has recently introduced 2 certificates. One is cybersecurity and the other is robotics. Both these certificate offerings are going to be made free of cost for members. Similarly, all the partner CPD resources, so ACCA has CPD partners, the CPD resources that they're going to offer to ACCA, they are also going to be discounted, and therefore you will be allowed a 20 to 30% discount on all those partner resources also. At the same time, CAANZ has 2 new courses, and they have offered a discount to ACCA members till the 30th of June on those 2 courses. In fact, if I can share this particular slide, it has all the details, but no, it will require me to change the form, change the setup of this webinar, which I don't want to tinker with. So let me once again restate: robotics and machine learning. That's one CPD certificate course that has been made free of cost for members. The other is cybersecurity, which will be launched in this week, and that will also be free of cost for ACCA members. Discounted partner offerings, Prodigy Learning, Accounting CPD, PPP, and Cross Knowledge, and Learn Signal. They're all from 20 to 30% discount being offered on all of their offerings for ACCA members. Partnership resources, the 2 new courses by CAANZ, 20% discount for ACCA members till 30th June, and 21-hour IFRS module from PwC from May onwards are also going to be accessible to all of you. Discounts on ACCA certificates, 30% for active members. Those are going to be, I mean, these are diplomas, these are diploma programs, and there's a 30% discount for active members that will be available to all the members. And new foundation certificate in practical data analytics, that is also something that we are working on currently, and once offered, it will be in June. That will be on a substantial discount for members. So I thought I'll come in and make this announcement. ACCA is emphasizing a lot on giving back to its members, making sure members get this opportunity to learn, to improve their skills, to remain relevant, and therefore contribute better to their business growth, post-COVID situation. So that is ACCA's aim. I hope most of you will want to avail these offers. If there is any question or there is any query that you have regarding these discounts, you may contact customer services in your respective countries, or otherwise you can write to me at haroon.jan@accaglobal.com. I'll spell my name. It's HAROON.JAN@accaglobal.com. You can write to me, and I will be able to direct you to the right individuals who will be able to offer you support. Thank you very much, and enjoy the rest of the session. Masudan, excellent show. I think a record number of participants at the moment. There are about 650 participants for your session. It goes to show how much people are interested in listening to IFRS 9. So please continue. Thank you very much. Okay, members, I just thought, since a lot of members are asking if the session has restarted or not. No, we are about to restart, but I'll take this opportunity to talk to all of you, since there are about 630 members from about 32 different countries who are listening to this webinar. So, good opportunity for us to give some messages out as well. Other than the CPD resources that I just talked about, ACCA globally has developed a pool of about 200 webinars that we are going to deliver in the next couple of months, and the process has already started. So you would have noticed an upsurge in the number of webinars and digital resources that we are now trying to produce. So first of all, we need your feedback about this. Do you think this is good engagement? Do you think the topics that we're bringing in, they are good? Do you think these are very useful? Are there any further topics that you think we need to bring in? I got a feedback from one of the members who is, who does BPO work, and he's got a top-rated profile on one of the BPO website, and he was saying that we need to have very operational information about the tax return filing system in different markets in different countries, and that he thought was going to improve the capability of his business under the circumstances. So I think that was good feedback, and that has been noted down. If there's any further feedback, if there are any further topics that you think are going to be relevant, do let us know. What we are aiming at delivering is a mix of technical and performance development related topics. So for example, soft skills, at the same time, some technical subjects like taxation, like financial reporting standards that we are currently doing, uh, like cash flow management or working capital management under the circumstances, like COVID related webinars, and how can members continue to add value to their businesses and their employers under the circumstances, how to remain relevant. So these are the topics that we have on top of our minds, and I think ACCA is once again leading the way with the number of engagements, with the way we've sat down, discussed how we need to, redefine our engagement plan with members, and then continue to implement it by bringing in a global approach. And now we will be promoting. I mean, currently we are promoting webinars on a regional basis, which is the Middle East and South Asian region. But we will be going ahead, bringing in webinar content from outside our region as well. So for example, if UK is delivering something for its members which could be relevant, we will give you access to it. If Asia Pac is doing something similar, and we feel that it's going to be beneficial for our members, so that's going to be offered to you as well. So that's the approach that we are following, which means there's a lot of content coming in. I know we don't want to pressurize you with attending 2 or 3 webinars every day. That's going to be a lot of concentration, a lot of work. But these are all recorded webinars, and you can, if you really like to attend one particular webinar, you can really go back and attend it offline, or maybe watch the recording. So that is, how we're going to facilitate members in this time. However, like I said, the general consensus is we want to keep our members relevant. We want to keep our members fully equipped, and we want them to continue to grow and flourish, even under the circumstances. That's what ACCA's foremost priority is at the moment. So once again, I am accessible for any of your feedback, or your member affairs team members in your respective markets are accessible. If you have any such information, any such feedback that you want to give, a topic that is of interest to you, and you would want a webinar to be arranged, or you are a member with certain skills, certain special skills, and you would want to come forward and deliver a similar webinar, please get in touch with me. I'll repeat my email address. In fact, I'll write it in the chat box and send it to all of you, and that is haroon.john@acccaglobal.com. So I am sending it to all of you. Thank you very much once again. I hope Umar Sudan is ready for his session. Umar Sudan, you can continue.
Yeah.
Thank you.
Thank you so much. So we are going to be back again. So 1 second. So I'm going to start sharing the slides. All right. So there you go. So super. So this is going to be a very important topic, IFRS 9, financial instruments, impairment of financial assets. As I previously discussed, it's very important in the current context that we are going to have a very interactive and session that I would expect to have a lot of questions coming up on mainly on this topic in the Q&A session. Right. Now, if you look at IAS 39 to IFRS 9, there has been a major transformation on how do we do an impairment testing for financial assets, right? If you look at in IAS 39, the standard followed an incurred loss model for impairment testing, meaning that you can only account for an impairment loss on a financial asset when a loss event has occurred. You cannot make an impairment provision to a financial investment regardless of however likely they are. You cannot create a provision until the loss is incurred. But IFRS 9 is having a forward-looking view on impairment testing, where we are going to follow expected credit losses approach in IFRS 9. Remember, we call them in ECL, and I will continue to use the terminology ECL in my presentation. So ECL stands for expected credit losses in IFRS 9, where we are talking about the probability of losses occurring in the future, and we are going to create provisions for expected losses. So which is a complete transformation from IAS 39 incurred loss model to IFRS 9 expected credit loss model. Remember, this topic is mainly applicable for financial assets measured at amortized cost. What are such assets? If you look at a bank's balance sheet, loans and advances, remember the banks are the single largest sector which is impacted by IFRS 9 implementation and also the post-COVID-19 scenario. Point number one. And also receivables in a trading or manufacturing company's balance sheet also qualify as financial asset and are subject to ECL, as well as any assets which have got a credit risk and it is measured at amortized cost in the balance sheet. Even then ECL becomes relevant for them. So that's from the scope of the standard, and now I'm going to take you through how impairment is done in various stages in IFRS 9 impairment of financial assets. If you start looking at a bank's loan portfolio, right, we can classify them into good loans. We call them performing loans. In banking terminology, we differentiate a loan into performing loan and a non-performing loan. We can call it NPLs. So a performing loan is a good loan where the customer keeps paying you the monthly or quarterly installments and the interest payments. And then there is also a second category which is called loans under observation or watch list, meaning there is a reduction in credit quality of these assets, right? So they are still performing, but they are assets which there is a significant deterioration of credit quality since the initial recognition. So this is the first one I'm talking about, is the performing loans, and then we are talking about stage 2, which is assets under observation, where there is a significant deterioration of credit quality of the assets, but the assets are still performing. Now, moving on to the third stage, what are they? There is an objective evidence of impairment. The loans are in default, meaning the customer has stopped paying dues on your loans to the bank. So meaning probably you can say in most regulations, if a customer's installment is in due for 3 consecutive months, we call them bad loans. So that is basically stage 3. So now stage 1 is high quality loans. Moving on to stage 2, there is a significant increase in credit risk. But moving from stage 2 to stage 3, things are moving from bad to worse now. Now, if you look at the impairment testing as per IFRS 9 and how it differentiated from IAS 39. If you take IAS 39, we only create provisioning based on stage 3, meaning that we can create impairment losses and the related provisions on loans, on the loan portfolio of banks, or even receivable from a trading company perspective, only when a loss event has occurred. Let's say a customer has gone into bankruptcy and stopped paying you the dues. You cannot create provision for stage 1 and stage 2. However, as per IFRS 9 forward-looking expected credit loss model, we will be creating provisions even for stage 1 and stage 2 assets. I mean, look at it. Even you create provisions for performing assets at the date of recognition. Even if there is no significant increase in the credit risk, you need to provide impairment losses against such assets. But moving on to stage 2, there is a significant increase in credit risk. We will look at it later. The standard gives guidelines on when do you consider there is a significant increase in the credit risk. So we will focus on that in the forthcoming slides as well. But if you move from stage 2 to stage 3, you are going from bad to worse, where you have actually had a loss event. So how do we account for these things? For stage 1 loans, where the loans are of good quality, you create ECL, expected credit losses, based on 12-month expected credit loss model. Meaning, what is the probability of this loan becoming bad or increase or default over the next 12 months? However, for stage 2 and stage 3 loan categories, we need to follow lifetime expected credit losses approach. So we are going to look at the cash flows of these financial assets over the maturity period and look at default probabilities and arrive at impairment losses using our ECL model on a lifetime ECL approach. So that is for stage 2 and stage 3, and stage 1 is only 12-month ECL. So a bank or a trading company, they have to split their loans into these 3 categories, put their customers into various buckets, either stage 1, 2, or 3, because that's going to have a significant impact on the classification and the measurement of impairment losses. As you can understand, 12-month ECL are going to be significantly lower than lifetime ECL. So stage 2 and stage 3, you need lifetime ECL, but for stage 1, you only need 12-month ECL. There is an important question that people are very often ask me, is that do you need lifetime ECL at initial recognition for some specific asset class? Remember, you mostly have 12-month ECL at the initial recognition. However, if you are purchasing credit impaired assets, maybe you are buying junk bonds, or if you are buying companies who are in default or who have incurred significant deterioration of credit quality. You are doing such investments because your risk appetite permits you to do so. You are doing it as part of your yield pickup strategy, whatever the reason it could be. You need to create a lifetime ECL even at the initial recognition for these type of instruments. So otherwise, most of the investment grade bonds or investment grade loans and advances, 12-month ECL at initial recognition could be sufficient. So there is a next slide which actually talks about what is stage 1, where the financial instrument whose credit quality has not significantly deteriorated since the initial recognition, right? So, I mean, if you look at the stage 2, where the credit quality of loans or these credit risky assets has significantly deteriorated since their initial recognition. So you move from 12-month ECL to lifetime ECL in stage 2. And stage 3, as I said, where a good loan becoming bad loan, where there is objective evidence of impairment. So if you understand the staging, stage 1 is a good loan. Stage 2, I mean, the customer is still good, but there is a significant increase in the credit risk, maybe because he's having liquidity issues, his industry is not doing well, or economic recession, whatever it could be, he is moved to stage 2. But stage 3 would mean the customer is actually in default, right? We will look at more examples in the next slide. And as I said, this is applicable for any financial assets with credit risk. Bonds, loans in a banking book, receivables in a trading company. Right. Now, look at this. This is a very important point, and I think this is very relevant to the current context that we are talking about. Right? How do we determine when a loan needs to move from stage 1 to stage 2 or stage 2 to stage 3? Most relevant question that anybody can ask at this moment, the COVID-19 and the resultant slowdown, has it resulted in an automatic shift of loans and receivables from stage 1 into stage 2, at least for mostly impacted sectors? The answer is, I mean, it depends, and also we will make use of the IASB guidelines issued in March 2020 to answer this question, how this is going to happen. I mean, is COVID-19 an impairment indicator? Yes, clearly it is a trigger. But do we update our ECL models? Do we change from 12-month expected losses to lifetime expected losses for most of our asset classes in selected industries? How do we do that, and what guidance is given by IASB, and what best practice that we can do based on the regulators' recommendations all over the world? So we are going to have a look at that. And before that, these are the usual credit deterioration triggers. These triggers will make you change or shift one customer from stage 1 to stage 2, which means you are moving from 12-month expected credit losses to lifetime ECL. So these are the factors: significant changes in the market indicators, increase in the credit risk, which will lead to credit spread, and significant change in credit rating, meaning a downgrade of a customer's credit rating, remember, is a trigger for impairment testing. Significant financial difficulty of borrowers, internal credit rating downgrade. This is very important mostly in the region. If you look at banks, they have lent to customers where the customers do not have a rating. I mean, they haven't received a rating from rating agencies, Moody's or S&P, or any reliable rating is not available. So basically, the banks of these industries needs to usually have an internal rating system where, based on the customer's history and their quality of collateral, quality of their assets, quality of their finances statements, they categorize them into various credit rating buckets. If you are downgrading one customer from risk rating 1 to risk rating 2 or 2 to 3, depending on whatever you have, simply because you feel that the customer is experiencing liquidity issues. Remember, that is again a trigger. You move from stage 1 to stage 2 or 3, depending on the situation. So significant change in the value of collateral. This is a very important thing at the moment. I mean, most of the companies use real estate properties or equity shares or bond investments as collaterals. Due to the significant fall in the financial markets post COVID-19, the collateral values of most banks' asset portfolio would have dropped. So that kind of issue also, it makes the portfolio of collateral less liquid. Significant change in external macroeconomic factors related to borrowing entities such as COVID-19, significant expected adverse change in the regulatory environment, the borrower. The last but not least, you are changing the risk premium to the borrower, thereby increasing the pricing due to deteriorating credit quality. So these are the indicators. So when these indicators are present, what do we do? Do we actually move from 12 months credit losses to lifetime credit losses? And what does IASB say at the moment? So I'm going to quickly go through them now before we go back and talk about some of the other interesting stuff. So this is the guidelines given by IASB. I mean, if you look at it, what is there in the red box, they clearly say COVID-19 does not automatically shift customers' loan categories from stage 1 to stage 2 or stage 2 to stage 3. There is no mechanistic approach in determining whether there is a significant increase in credit risk or not. Right? You need to take into account payment holidays. I mean, this is kind of something which is an increasing trend in most countries. Banks are giving payment holidays to companies who have been impacted by the COVID-19 slowdown. Does it mean such financial assets will need to be moved to stage 2 or stage 3? The standard clearly says no. A simple payment holiday does not result in significant increase in the credit risk. You've got to assess the situation holistically and see, is the COVID-19 impact going to be a long-lasting one, or is it going to be a temporary one? So you've got to make use of all this, and most importantly, remember, in estimating your ECL losses, you need to consider the significant government support measures given by the respective governments and central banks. Why? Because these measures actually will have an offsetting effect in your ECL model. Why? COVID-19, if you look at it on a standalone basis, you might have to write off most of your assets. But if you look at the government support coming in and monetary and fiscal easing that have taken place, that's going to have an offsetting effect in your ECL models, reducing the provisioning requirements in that case. So that needs to be taken into account, but definitely you need to update the macroeconomic variables as part of your ECL models. If you cannot determine the impact in the short term, this is the case because there is a greater uncertainty on what's going to happen. We have new news coming up, new economic releases coming up every day as the infections spread out. So basically, we cannot determine the impact right away. So whenever as and when the information becomes available, you need to do an adjustment immediately. Look at this statement. If the effects of COVID-19 cannot be reflected in models, post-model overlays or adjustments will need to be considered. So this is something which is super important at the moment. And if you look at it, IASB also says, look at your local regulator. What do they say? I mean, European Banking Authority, European Central Bank, European Securities and Market Authorities have already issued guidelines on what needs to be done. So it's better if people in those jurisdictions make use of those guidance in updating their ECL models and what needs to be done. Again, the guideline says do not use a mechanical approach, do a comprehensive assessment and do a holistic approach for your ECL measurement. Also, you can take a note of your government support coming into you. So those are the stuff which IASB has actually given. And then I also have given an example, mainly taking into account trade receivables, right? How can we estimate the ECL losses on a trade receivable, which is kind of a different scenario so far, mainly emphasized on the banks where the ECL is a big thing. But even for a trading organization, you have large trade receivable, you need to think about your ECL. So in that case, you definitely need to use a scenario analysis to come out with your expected credit losses. So that's what the guidelines and IFRS 9 says. You've got to come up with best case scenario, most likely scenario, or worst case scenario. I have given an example in this slide. You can go through later as you have your slides now with you, so you can spend time and have a look at that. I have given a very simple example, but in practice it may be an exhaustive exercise, but simply the logic remains the same. My best case scenario is the restaurants are reopening in 1 month, because I'm talking about a restaurant business, right? The borrower of the trading company is in restaurant business, or restaurants reopening in 3 months following COVID, or reopening in 6 months. With respected probabilities, you estimate the losses, and then you recognize your receivable into your balance sheet, the original amount 1 million minus your expected credit losses, which is calculated based on a probability of default approach. So that's how you do a scenario planning, you do a PD and scenario planning, combine them together, come out with an ECL, because times are very, very uncertain. So IFRS 9 says make use of scenario planning in estimating your ECL for trade receivable at this point in time. So going back to one last slide before we actually go into the last topic, which is going to be most important topic, is how do we calculate expected credit losses in a bank, right? We typically said that you need to classify customers into 3 categories: stage 1, stage 2, and stage 3, where we said stage 1 is 12 months expected credit losses, and stage 2 and stage 3 you need lifetime expected credit losses. So we understand that. So how do we calculate the impairment loss? Remember, the impairment loss is calculated as exposure times PD times LGD. Look at the blue box. Everywhere where I have a blue box or a red box, that is where you need to pay your attention, because that's a very strong message I'm trying to communicate, because it's very, very important. So impairment means you take your exposure times your probability of default times loss given default. So I'm going to quickly explain you what is probability of default, what is exposure at default, and what is loss given default. Probability of default is basically the likelihood of a good customer becoming bad in the future. What is the probability of default, right? For retail customers, you can go by historical loan loss experiences and behavioral scores of such customers. You can look at it, customers, you can categorize them by the income level or their repayment capacity or collateral value, and identify what is the historical loan experiences and apply those PD values which you obtain from your historical analysis or back testing, you call it. Use those numbers into your retail portfolio. But if you are running a corporate portfolio, most companies go by published credit ratings of rating agencies. So rating agencies are going to tell you PDs for, they are going to publish PDs for various rating customers. I mean, as per their rating grade. I can give you an example here. If you say, they can say triple B, the credit rate for the customers rated triple B, the PD is 2.5%, double B 3.25, and B 4%, etc. It's a hypothetical example. So meaning that you can notice as the credit quality deteriorates from triple B to B, the PD increases. So which is logical. Why? Because as the customer gets downgraded, there is a deterioration of credit quality, there is an increase in probability of default. It's more likely than not the customer will become back in the future. So that's PD, which is very important. A bank or a company with large receivables or a credit risky asset needs to calculate and establish PDs. Number two, LGDs, which is again a least understood topic. What is loss given default is basically the amount of loss that you would incur at the time of default. If you have credit risk mitigants, meaning that if you have collaterals or securities against a loan that you have granted, that could reduce your LGD. What do I mean by that? Let's say you have granted a loan to a customer where 80% of the loan is covered by a collateral. So meaning what is subject to loss even at the time of default is only 20%. Why? Because you have 80% of the value as collateral. As long as you can liquidate the collateral at the 80% of the value, if you can do that, then the actual LGD that you are going to incur is only 20%. Why? Because that's going to be your loss given default subject to collateral adjustment. So LGD is very important. So even if you have a PD of 100, your loan losses cannot be 100% because if you have collaterals. So collaterals will reduce your impairment losses, which makes logically sense because these securities can be liquidated at the time of default. So that's on loss given default, probability of default. So what we do, we multiply your exposure, which is your loan outstanding or receivable outstanding or whatever the asset outstanding at the time of impairment testing times probability of default times LGD is going to give you the impairment loss. So that's how you do it. There's an interesting example underneath and how the impairment is done. So you can go through this later on, and then if you have a question, we can take it offline. So that's pretty much on IFRS 9, impairment of financial assets. Remember, which is very, very important in general, and the importance has significantly gone up in the current context. So now I'm moving on to the last bit of our session today, which is IFRS 9 hedge accounting, right? It is known to be a most robust and complex accounting treatment, and IFRS 9 transformed the traditional hedge accounting in IAS 39. And most importantly, I'm going to focus on the LIBOR transition project and the current exposure draft in place on hedge accounting as we move forward to replace LIBOR by December 2021 with a new adjusted risk-free return. So it probably be a topic that is known to you, I mean, or it's a new topic to you depending on your background. What do you do at work, but it can give you a basic understanding on what's going on now. So before that, I'll spend about 10 minutes over the next 10 minutes, I'm going to give you a basic understanding on what hedge accounting is, what derivatives are, before we go and talk about more advanced stuff. So, I mean, I'm ignoring definitions due to time constraints, but I'm going to make use of most of the diagrams to illustrate what we are looking at and why we are looking at, right? So that's very important. Look at this. Using this diagram, I'm going to explain you what is hedge accounting, what is a hedged risk, what is a hedged item, and what is a hedging instrument. Pay attention, pay close attention to the example in this diagram. Look at this. I'm talking about a forecast international trade, which is expected to happen from a year from now. So what's happening? A UK exporter is going to export 1 million pounds worth of goods after a year to a US importer who's going to import them in a year's time. So now, remember the hedged item. What are we trying to hedge? Is this particular transaction. This is a transaction that we are trying to hedge. So this transaction, this probable transaction, becomes your hedged item. You call it an underlying item or a hedged item, whatever the way you want to call it. Right. Now, what is the risk the importer is trying to hedge? What he is worried about? This importer is worried in case if the dollar depreciates against pounds in a year from now, what's going to happen? He needs to pay more dollars to convert them into 1 million pounds. So he needs more dollars than what he would need if he is to pay this money now. So that's why he's thinking, how do I manage this risk? He is entering into a forward contract with a bank, typically a counterparty, to buy GBP, the sterling pound, in 1 year at a fixed rate of 1.22. Look at this particular blue box where I say he enters into a 1 year forward to buy GBP at a fixed rate of 1.22. So irrespective of whatever happens after 1 year, this importer is going to pay the bank $1.22 million at a fixed rate to receive 1 million GBP, which in turn he will use to pay for the UK exporter. So in this case, this hedging instrument, this forward contract becomes a hedging instrument. So this is a hedging instrument, this is the hedge risk, and this is the hedge item. So this is the objective of this particular slide, is to understand what is hedge risk, hedged item, and hedging instrument. You also need to understand what is a derivative. Remember, a derivative is basically a hedging instrument, right? And remember, the fair value of a derivative will change depending on a change in the exchange rate, depending on a change in the interest rate, or depend on a change in the price of a commodity, depending on what you are trying to hedge. If you look at this particular example, you have a forward contract to buy GBP at a fixed rate in the future. And if you think about the fair value of this particular hedging instrument, what factors would have an impact on the fair value of a hedging instrument? Remember that spot rates, the movement in the spot rates between GBP and US dollars in the spot market is a one main important factor determining the market value of the forward contracts. Let's say after the hedge agreement is entered between the customer and the counterparty, let's say dollar starts to appreciate. So hedge is becoming counterproductive now. Dollar is now 1.18. So the customer could have been better off not having a hedging instrument. In this case, the hedge is becoming less valuable and the forward contract is going to fall in value if you do a mark-to-market exercise on them. In the meantime, let's say the dollar depreciates against GBP and currently at 1.25. then the hedging instrument offers significant benefit to buy GBP at 1.22. In that case, the hedging instrument is more valuable. The fair value of the hedging instrument is going to go up. So that's basically what you need to understand, how the fair value of a derivative is impacted. Right. So now in this context, remember something, any changes in the fair value of a derivative, whether you are measuring them at you are using hedge accounting or not, that you need to measure your derivative, remember, at fair value. That's a very important learning outcome here to understand. Always derivatives must be at fair value, whether you use hedge accounting or not. Now, there are three types of hedges: fair value hedges, cash flow hedges, and hedge of a net investment in a foreign subsidiary, in a foreign operation. So that's those are the three types of hedges. What is a fair value hedge? Meaning that you have an inventory in your balance sheet or a financial asset, or you have a receivable or a payable in your balance sheet, which is subject to risk due to changes in the fair value. Let's say if you have inventories in your balance sheet, crude oil inventories in your balance sheet, you expect the crude oil prices to come down, so you are expecting a commodity price risk leading to a fair value hedge on your commodity in your balance sheet, inventory in your balance sheet. So you can enter into a hedge against falling crude oil prices to protect your inventory, crude oil inventories, which will be a fair value hedge. Also remember, a fixed bond, fixed paying bond is also another example of fair value hedge. And what is cash flow hedge and what is fair value hedge? And I'm going to explain you in the next category before we come into the last point, hedge of a net investment in foreign operations. Look at this, depending on what is being hedged. If you are hedging a fixed rated loan or a fixed rated bond or inventories, it's more likely it is a fair value hedge. Look at it, fixed interest loan, fixed interest bond, inventories. They are actually fair value hedges, simply because if you look at a fixed interest loan or a fixed interest bond, they are subject to fair value risks. Why? Because these bonds pay you a fixed interest rate, interest at a fixed coupon. So what will happen is when the interest rates go up in the market, these bonds will become less attractive. So investors start selling these bonds, reducing the fair value of the bonds. That's why we say there is an inverse relationship between interest rates and bond values. When the interest rates go up, fair value of bonds drops. When the interest rate comes down, the fair value of the bonds go up. So if you have a fixed interest rate bond, because you are not going to change the interest rate on such bonds, the coupon rates are fixed. So depending on the market interest rate changes, if it goes up, it's bad for fixed paying bond, because the fixed paying bond will be paying interest at fixed rate. But in the market, if you are buying new bonds, you can buy it at a higher interest rate. Therefore, when interest rates go up on a fixed paying bond, the market fair values are going to drop. So there is a fair value hedge that you are trying to hedge. So what I'm trying to tell you is, if you have fixed interest rate loan, fixed interest rate bond, inventories, receivables, which you are trying to hedge, you are trying to hedge the fair value changes, they are fair value hedges. But if you have a variable interest rate loan, variable interest rate bonds, or a forecast future transactions involving cash flows, where what is subject to risk are the cash flows, because when the interest rates go up or come down, it's going to affect the cash flows in your hedged item. That's going to be classified as variable items, therefore it becomes a cash flow hedge. Again, coming back to this, now we understand what is fair value hedge and what is cash flow hedge. Now, why such classification is very important? Because such classification, remember, is going to have an impact on the accounting treatment, because accounting treatment for cash flow hedges, fair value hedges are actually different. And there is also hedge of a net investment in a foreign operations. If you have a foreign subsidiary and you are the parent company with domestic operations, you have one or more foreign subsidiary. So any changes in the functional currencies and reporting currencies and the exchange rates will have an impact on your net investment. So hedging the net exposure on a foreign subsidiary is part of this, and that's specifically also covered in IAS 21. Right, so having said this, now I'm going to talk about what changed in IFRS 9. If you are moving from IAS 39 into IFRS 9, what are the key things what have changed? I mean, there are so many things which have not changed, which is a good news. I mean, look at what are the common features between both the standards. The hedge accounting is optional in both standards. You can choose to, or you can choose not to use hedge accounting, right? The common terminologies that you use: hedging instrument, hedged item, fair value hedges, cash flow hedges. Everything else is pretty much unchanged in IFRS 9 when they transited into a new standard. Both standards require hedge documentation to qualify for hedge accounting. What is hedge documentation? You need to document what is your hedged item, what is your derivative, what is the relationship between them. You need to have a formal documentation to establish a relationship between an underlying item and a hedging instrument. And hedge classification is the same in 39 and IFRS 9. And so again, the concept of hedge effectiveness is accounted in P&L, but although remember there is a big difference between how you understand and define hedge effectiveness in IFRS 9 compared to IAS 39. But in terms of accounting treatment, it's the same in both standards, right? Now I'm going to talk to you about more interesting stuff. What changed in IFRS 9? Point number one, what is permitted to be a hedging instrument, right? What do we mean by this? I mean, in IAS 39, they say you can only use a derivative to hedge a hedged item. You cannot hedge your exchange rate risk or interest rate risk using anything other than a hedging instrument such as forward contract, futures, or options, or a swap. You cannot use anything else to hedge. If you use, it's up to you, but standard setters do not allow you to use hedge accounting in that case. Hedge accounting is only permitted when you are hedging a risk using a formal derivative contract. But remember, in IFRS 9, they are trying to align the practical way of managing risk into risk management. So they allow you to hedge risks in the practical way, how a risk manager or a risk practitioner managing the risk in practice. Think about if you want to hedge your dollars, right? You probably can enter into a forward contract to buy or sell dollars, or you can also buy another currency which is expected to behave negatively or which exhibits a negative correlation with the dollars. You could, by investing into those currencies, remember, you are creating a natural hedge. Or if you have an asset and you can create a liability, you can create a natural hedge, right? So if you are trying to hedge using any other method, I mean, the standard allows that to be a hedging instrument, right? You can actually still use hedging hedge accounting if you are using a non-derivative asset or liability to risk management, right? Next question, what is permitted to be a hedged item? Let's look at this interesting diagram here. It's getting more interesting now. What's the difference between IAS 39 and IFRS 9? In IAS 39, all aspects of a non-financial item needs to be hedged. What do we mean by all aspects of a non-financial item? Look at an airline company trying to hedge its jet fuel. Jet fuel being the major energy source for the functioning of an aircraft, right? So they are trying to hedge the jet fuel. Let's think about an European airline company trying to hedge the jet fuel. They have two major sources of risk. One is the price risk. The crude oil prices can go up, making it expensive for the airliner to fund its energy prices. Number two, the foreign currency risk, meaning the oil prices are denominated in dollars. So when you are buying them, your currency is euro. So you are having an exchange rate risk, which is increasing the risk exposure of jet fuel. As per IAS 39, if you are hedging jet fuel, you should hedge every aspect of the of the jet fuel to hedge, to qualify for hedge accounting. If you want to qualify for hedge accounting, you need to hedge the price risk by entering into a forward contract on commodities. You need to enter into a forward contract to hedge against a foreign currency risk. Only then it becomes a hedged item. Right? But however, remember in IFRS 9, if a company's risk manager determines he only wants to hedge the price risk aspect of the jet fuel and he wants to leave the other elements unhedged because it may be his company decision or their own risk appetite to not to hedge foreign currency risk. They probably want to have an open position on their foreign currencies, or they think such risk is not significant. Whatever it could be, IFRS 9 says you hedge them. I mean, if you want to hedge only one item, we are fine with that. Still, you can use that particular contract as a hedging instrument and the underlying items as a hedged item. So IFRS 9 making things simple for you, aligning more into practical ways of managing risk. So that's something that you need to understand. What is permitted to be a hedged accounting is continuing. Previously, you cannot hedge net positions in IAS 39. You can hedge up to you, but they don't allow hedge accounting. But now in IFRS 9, you can hedge net positions. It's not mandatory anymore that you need to hedge gross exposures. I mean, in practice, think about it. You have a 200 million assets in a foreign currency. You have 150 million liability in a foreign currency. It's logical. It makes sense for the risk manager to hedge the 50 million net exposure instead of hedging 200 million assets separately, 150 million liability separately. Remember, IFRS 9 allows hedging of net exposures, which is probably the practical way of managing the risks. And the next point is very important. I will touch upon that when we talk about the LIBOR transition project at the end. Look at what does this mean. Rebalancing a hedge means modifying a hedge in IFRS 9. So you're rebalancing a hedge. Whatever the reason it could be, maybe the notional value of your underlying assets or liabilities have changed, you are rebalancing. So when you are rebalancing in IAS 39, you got to terminate your hedging relationship, start the new hedge documentation all over again, making the whole process troublesome. But IFRS 9 says it's a modification on the hedge. That's how practically how risks are actually managed. The last point that I would want to emphasize before we move on to the accounting treatment is hedge effectiveness testing. Look at this. This is very interesting, the change from IAS 39 into IFRS 9. How did we define hedge accounting in IAS 39? Remember, we defined hedge accounting, hedge effectiveness based on quantitative 80-125 rule. What do we mean by that? Before that, you guys need to understand what do we mean by hedge effectiveness. Remember, hedge effectiveness is the extent at which your hedging instrument is offering you the hedge protection, meaning the extent at which the change in the fair value of your hedging instrument is going to offset the changes in the fair value of your underlying asset or a liability, right? If you go back to the inventory example that I gave you earlier, a company having crude oil inventory in their balance sheet and they are trying to hedge the risk using futures. So in this case, when the oil price falls, it's going to have a loss on your market value of the inventories in the balance sheet. But remember, the derivative value, the fair value of the derivative needs to go up to offset the losses on the inventory. So hedge effectiveness, remember, is always the extent at which your hedge is effective, the extent at which your hedging instrument is increasing or decreasing in fair value in response to a change in the fair value or cash flow of your underlying hedged item. Now, what does IAS 39 say? In order to qualify for hedge accounting, your changes in the fair value of your derivative and changes in the fair value of your hedging instrument, hedging exposure, the underlying asset, needs to be put into a formula, a ratio, and you're going to compare them. You're going to compare two things: changes in the fair value of hedged item, changes in the fair value of hedging instrument. If both changes, one divided by the other, right? Usually we divide the fair value changes in the hedging instrument divided by fair value changes in the underlying exposure. If this ratio is between 80 to 125%, the hedge is considered to be effective. Hedge accounting is permitted. However, the standard setters did not know, or they never had an answer where this 80-125 rule came up in IAS 39. Where did they derive these percentages? Only God knows. So what they did in the new standard in IFRS 9, they say they completely stopped the quantitative arbitrary 80-125 hedge effectiveness testing and introduced more kind of qualitative hedge effectiveness testing. Meaning, if a risk manager is able to demonstrate the hedge is actually going up in value when your hedge underlying asset is coming down in value, and hedging instrument is going down in value when your underlying exposure is going up in value, there is a negative correlation between your hedged item and hedging instrument, meaning the hedge is effective and that's why you are using it. That's how practically how risk managers would manage risk, whether it's up to them whether they want to manage, whether they want to hedge 50% of the risk or 80% of the risk or 100% of the risk. It's not up to the standard setters but up to the risk managers managing the company, the CRO's role, not the standard setters role. So that's why I appreciate the changes that came up in IFRS 9 on hedge accounting, mainly on impairment testing. So that's pretty much on the introduction. If you look at the accounting treatment in fair value changes, fair value hedges and cash flow hedges, how do we account for them? Remember, I said at the beginning, the classification is important because the accounting treatment is different. All derivatives must be at fair value, point number one. Point number two, fair value changes in fair value hedges, which is the MTM on your hedging instruments on fair value hedges, needs to be taken to income statement with the corresponding adjustment in your hedging financial asset or liability in your balance sheet. So, and this is kind of a beautiful slide. It summarizes the hedge account for fair value hedges. You can go through them in detail. And then cash flow hedges, the same thing which we do, we measure them at fair value. But remember, the fair value changes of cash flow hedges, right? Meaning the fair value changes of hedges which are designated as fair value hedges. The gain or losses needs to be taken to OCI. However, there is something that you need to pay attention. You need to divide the hedge gain or losses, right, into two types. You need to split the MTM changes on your cash flow hedges into two: effective portion and ineffective portion. Effective portion of a cash flow hedge resulting from MTM exercise needs to go to OCI, whereas ineffective portion taken to income statement. Remember, always ineffective portion is taken to income statement, whether it is cash flow hedge or fair value hedge. In this case, with the corresponding asset liability adjustment in the balance sheet, where you see a derivative asset or liabilities in your respective balance sheet. Again, you can go through them when you have some free time, this accounting treatment, and I also have given steps on how you look at this accounting. Okay, the last topic, which is going to be very important at the moment, I'm going to do this for the next 10 to 15 minutes and then leave the rest of the session to take up some of the questions that have already come up. And I also recommend you can come up with new questions. And as I said, if I don't answer any questions now, I mean, if you have any difficult questions which you do not find answers, please feel free to reach out to me. You can email me at the email address given at the end of the slides. So this is an IBOR reform and hedge accounting. As I said, some of you may be familiar with it. If you are dealing with treasury, or if you are working in a bank, but then you may not be familiar as well. My objective is to give you a perspective on this and how the hedge accounting is going to change and what are the things companies need to do, not mainly from an accounting perspective, but just to give you a broader perspective on what's happening on this spectrum on IBOR reform. So look at this in simple terms. What are we trying to do? What is happening now? LIBOR, London Interbank Offered Rate, which is what we call LIBOR, which has been a key benchmark interest rate in the past up to now, is going to be completely replaced by an adjusted risk-free rate by December 2021. Remember, December 2021 is the deadline for companies releasing LIBOR data. So meaning that all your assets and liabilities which use LIBOR as a benchmark or a reference rate needs to now change into a risk-free rate. Now the question is, I mean, how can you compare LIBOR and a risk-free rate? LIBOR got a credit risk element in it, right? Because LIBOR is the interest rate on overnight lending between banks. So meaning that there is a credit risk embedded into it. So meaning if when you are adjusting the risk-free rate, as it's stated in the term itself, it's risk-free rate on a currency, meaning it's probably the treasury bill or treasury bond rates we are talking about as risk-free rate. You need to do a spread adjustment. Remember, the spread reflects the credit risk, right? And then the duration adjustment, depending on, are you looking at 3 months, 6 months, 9 months, or 1 year, whatever the interest rate that you are looking at, there is a duration adjustment needs to be done as well. So this is a transition. Now, why LIBOR is very important now, as you see in this where I'm moving the cursors: variable interest rate loans, syndicated loans, variable interest rate bonds, or term loans with prices linked to LIBOR. All these products where the benchmark rate, or you call it the reference rate, is basically LIBOR, meaning these products are priced a LIBOR plus a margin, Meaning, when I say a LIBOR plus margin, when the interest rates go up in the market or come down in the market, these rates are going to be readjusted. They are going to be repriced. So that's why we say this is very important. Mainly look at the last two. On the interest rate hedging, there is something called swaps. If you have a fixed rated bond or a floating rated bond, or a fixed rate liability or a floating rate liability, depending on whatever you have, you can enter into a swap contract with a counterparty to hedge your interest rate risk. It could be a pay fixed, receive floating hedge, or it could be receive fixed, pay floating hedge. So these hedges also need to change in response to the change in the benchmark. So something which is very, very important. Remember, by December 2021, LIBOR should be fully replaced by the respective risk-adjusted risk-free rates. And then, look, it's getting more interesting now. These guys, I mean, FCA, you call it Financial Conduct Authority, they have issued a statement in April, and they have said Corona is not going to affect their deadline. So meaning that they are going to still replace LIBOR by December 2021, despite COVID-19 and the related impact. I mean, now if you want to understand why this project is important and why this is triggered, because I mean, if you see LIBOR, the way it is calculated, there have been years of LIBOR manipulation and LIBOR rigging due to the security issues that led banks to involve in LIBOR rigging, and banks have historically paid huge fines on LIBOR rigging to their respective regulators and clearing houses in the past. So in order to avoid that, they want to come up with much more stable, less manipulative rate as the benchmark rate. So that's what is going to happen. And then in the US, if you see what's happening is LIBOR is, getting replaced for something called SOFR. You call it SOFR. So LIBOR is changing towards SOFR. In United Kingdom, LIBOR is going towards SONIA or NIA. So what's happening is these countries, their respective currencies, they have already come up with these rates. So at the moment, you can compare the LIBOR and these rates to see how they are moving. Is it a good benchmark for LIBOR? Can it really replace? So a lot of analysis is going on. And most interestingly, in the UK and US, a lot of new bond issues, if you look at it, they are on the new rates. The benchmark rates for those variable issues are the new rates, SOFR or SONIA, not LIBOR. LIBOR, they are already more than 50% of the new bond issues coming up in the market are actually based in the new benchmark rate. But disappointingly, most of the hedging contracts are still linked to LIBOR. That's why now I'm coming to the most important point. What's going to change is basically due to the implementation of the new benchmark rates, which is replacing your existing LIBOR. I mean, how that would have an accounting implications for you. Modification of financial instruments. Why? Because there's going to be new instruments, new benchmarks, so that's going to change the cash flows relating to your hedge, meaning that you need to account for it in IFRS 9, modification of financial instrument. You got to now update your hedge documentation and effectiveness testing. Why? Because the benchmark itself has changed. Right? So what you are hedging, again using what is changing. So there needs to be an update on the documentation, and also still separately identifiable risk components not yet established in the benchmark rates. So what's happening currently is IASB has issued an exposure draft with a 45-day response period ending 21st May 2020. So finally, we would expect IASB to come up with a complete standard on a complete accounting treatment on IBOR transition by Q3 of 2020. At the moment, it is just an exposure draft. If you want more understanding on this, just do a Google search for exposure draft on IB or IBOR transition. It will take you to the International Accounting Standard Board page where the exposure draft is available. It's a single one-page document which can be easily understood. So the last topic before we move on to question and answer session. Are you ready for a new benchmark? This is what companies need to look at. You need to look at your LIBOR exposures. Do you have any hedging exposures which is linked to LIBOR, which are typically interest rate hedges? Do you have any assets or liabilities which are linked to LIBOR, which is pretty much relevant for a bank where most of its dollar exposures are LIBOR driven. Also applicable to borrowers in various sectors where they have liabilities or assets which are LIBOR driven. So the first step, looking at your derivatives and your existing assets or liabilities, what is your LIBOR exposure? What's going to happen when they get changed into a new benchmark rate? You've got to be ready with an impact analysis to provide to your respective board or CEO, because this is going to be very important for banks as well as non-banks who are involved in activities linked to LIBOR. You should take appropriate action. What is your callback clause in your agreement? Meaning that if you have a loan agreement, if the benchmark is changing, what is the fallback clauses, what needs to be done? Those terms are stipulated, might have been stipulated in your contract. Look at that, get ready, make appropriate action, the accounting implications, do an impact analysis, and be ready. System changes, definitely your treasury systems now need to capture the new benchmark. Your MTM process needs to change to the new benchmark. So there is so much to wait, and Bloomberg is already releasing some data on SOFR and SONIA as well. So the data is already available. And also remember, the new products must be referenced to a risk-free return. So I'm not going to focus much on IFRS 7. Why? Because it's a disclosure standard. It talks about all the things that needs to be disclosed as part of your financial instrument, with a greater emphasis on the risks faced by financial assets needs to be disclosed to provide more transparency to the stakeholders involved in financial reporting process. So we got just nearly 15 minutes left to complete the session, and then thank you very much for being online and asking questions. So I'm going to now see the number of questions that we can take. I mean, it's very interesting to see we have nearly 550 people on board here from different part of the world at different time zones. And it's really exciting to have a look at these questions and then answer those questions. I'm really impressed to see the amount of interest that's shown on this during these unprecedented challenging times, and spending time. You guys are spending time to improve yourself, improving your knowledge, which is kind of a great thing, the best thing that you can do in an otherwise difficult, extremely difficult period. So I'm going to start looking at the questions here. Nisam, are you there? For some reason, I'm not able to see questions.
Yeah, I'm here. So what is the problem you're facing, sir?
So what's basically happening is the question bar is actually replaced with something called chats for me here. I have something called sharing webcam, audio, dashboard, polls, handout, and chat. Okay, I think I got it now.
Did you find it?
Yeah, 1 second. I'm trying to see. It has probably got hidden somewhere here.
If you
Yeah,
if you
I
wish, I
got
can.
them now. I got them
Okay, great.
now. So I'm starting to see the questions, so it's fine. So I'm going to take the questions. I mean, the first question is on from Sarah. The question is asked at 3:12 p.m. What is loss given default? So the question is on loss given default, what it is. Remember, loss given default is basically the actual loss that is estimated to be incurred at the time of default by a customer. I can give you an example. Let's think, put yourself into a bank, right? You are lending money to somebody, and let's say that the default amount is $100 million. You have lent money to a customer for $100 million, and the probability of default is 100%. The customer is bankrupt. But remember, you can recover 50% of this exposure by selling the securities the customer has given you. Let's say he has pledged or mortgaged his real estate properties with you, right? So since he has pledged the real estate portfolios with you, you will be able to sell them, liquidate them, and recover half of the money. So meaning the 100 million exposure will become only 50 million net loss for you, because half the money can actually be recovered. So loss given default is basically tell you how much you will lose in times of a default. If you do not have any collaterals, you do not have any form of risk mitigant, your loss given default is 100%. Meaning if you are a trading company, have given goods on credit, you have sold goods on credit to customers, in that case, you do not have any securities, meaning I would assume an LGD of 100%. Hope you are fine with that question. I'm going to look into the next question. There is a question from Mohammed. If changes in the fair value of the liabilities due to changes in the entity's own credit risk, it will be charged to OCI. My question is, if a loan restructuring happens due to a change in an entity's own credit risk, the gain arising on restructuring will be charged to OCI. That's exactly correct. I mean, your understanding is fine. Any fair value changes arising from your financial liability relating to your own credit risk need to be taken to OCI. Anything related to other factors needs to be taken to income statement. Next question is from Mohammed Aslam. Thanks for asking this question. Are accounts receivables financial instruments? Yes, of course, they are financial instruments. As I said, anything which got a credit risk associated with them will become part of IFRS 9, Impairment of Financial Instrument Accounting Standard. So that needs to be also considered as a financial instrument as well. Right, now the rest of the questions are actually for admin, so I'm trying to see if there are more questions coming up. I would like to see more questions coming up from people. So I got about 10 minutes left before we can complete the session. The last question that I received at 3:12. If you have any questions. Okay, there is a question come up. One more question. Okay, I have a fixed rate debt instrument carrying a profit at 6% annually. It is measured at amortized cost as of the reporting date, market interest rates rises to 12%. Will the impairment arises due to changes in the market interest rate or the debt instrument will only be tested for changes in credit risk of the issuer as at the reporting date? This is a very interesting question that you have raised. Right now, first of all, the question for you is that if you are looking at a fixed rate debt instrument, I would assume that you are talking about a financial liability. Anyway, let me answer your question in both ways. If you are using, if you are talking about a fixed rated bond investment carrying 6% profit annually, in this case, I would say you got to go back and see what is your classification in financial assets if you are thinking it's a financial assets. So as you say, it's measured at amortized cost. I would actually think you got to carry out an impairment testing because it's a credit risky asset. So based on the impairment testing, you need to estimate the probability of default and the loss given default and identify the ECL related to this and take it as part of your income statement. You do not really need to think about credit risk or market risk when it comes to a financial asset classification. Remember, as I said previously, when you talk about a financial liability and you are using fair value measurement for financial liability, that is when splitting the fair value change into market risk and credit risk becomes very, very important. Why? Because we do not want a company to gain benefit over a fall in their own credit risk. So from a buyer's perspective, from a financial asset perspective, impairment losses are always taken to income statement. So therefore, there is nothing that you need to be worried about. But remember, when you are talking about a financial liability, which is measured at fair value. So when you say financial liability measured at fair value, that's where I focus on, where you need to split the fair value changes due to interest rate risk and due to other factors. Now, as you clearly say, the existing effective interest rate on the bond is 6%, and you are also saying the market interest rate rises to 12% at the reporting rate. So you need to compare basically the existing effective interest rate and the market interest rates, and you need to actually identify based on the new effective interest rate what would be the fair value of the bond. Right? Let's say, for example, your carrying value is 100, which is the amortized cost, but the fair value is 60. So you have a 40 loss you are talking about. Now, out of this 40 loss, you need to split them up into two. So I will give you an easier way to do this practically. If you are talking about a 40 loss, you want to know how much of this financial liability related to credit risk and how much of this financial liability related to other risk factors. I think it's best to do, you do a bond cash flows at 12 and discount them at 12%. You do a bond cash flow at discounting by 6%, which is your carrying value. Identify the difference. Let's say that difference is 30. So meaning you are able to identify and split out the market risk changes arising, the fair value changes arising from market risk is 30 based on your effective interest rate fair value methodology. So you have a balancing figure. You have 40 is total fair value loss, 30 is due to market factors. The balance is probably because the credit risk of the company has increased now. So I would take 10 to OCI, which is I estimate to have it due to the credit risk. The balance 30, I would take it to income statement. Of course, there are various methods available in practice to split out the credit risk from the fair value changes arising from the credit risk and market risk, and you are open to do whatever very sensible and reasonable in practice. That's a very brilliant question from Muhammad Daniel. So the question asked at 3:17, and now I got just 5 minutes left. If there are more questions coming up, okay, I have already taken that question as well. Okay, let's see, are there more questions coming up? Yeah, that's an interesting question here. A loan is restructured and the difference between present value of existing and new structured liability is more than 10%. Does it mean that the old liability will be first credited to P&L as an income, or a new liability will be recognized by charging an expense to P&L? Okay, this is what it is. Remember, Mohammed, thanks for the question again. I mean, you are keeping the momentum up. It's again a good question. I mean, remember, if the change in the present value of loans is greater than 10%, the difference between the existing loan and the new loans is greater than 10%, the existing loan will be derecognized, meaning any such differences between the existing loan and the new loan needs to be taken to income statement. It may be more or less. If you are talking about, let's say, a gain, then I would say the new liability value is lower than the existing liability value. So your entries would be, you are going to debit your existing financial liability and you are going to credit your new financial liability, which is lower than the existing liability, and a credit to income statement for the balancing figure. If you have a loss on the modification, right, extinguishment of the modification, then it becomes you debit financial liability, debit income statement the loss, and credit a new financial liability. To answer to your income, to a question in one line, these are considered to be derecognition of existing liability and creation of new liability. So which means what you need to do is you need to derecognize the existing liabilities and recognize a new liability. Any gain or losses needs to be taken to income statement. So that's a question. Thank you so much for the questions. There is another question. At stage 1, do we have to provide for total receivables for 12 months? Yes, that's a good question from Harun. Thank you so much on asking a question on impairment of assets for receivables. I mean, as I said previously, for receivables in a trading company or a manufacturing company needs to be tested for impairment. Even at initial recognition, you need to create a provision for 12 months ECL. Depending on your historical bad debts experience of selected customers, I recommend you, Harun, you do not do this exercise for the whole invent receivable portfolio. You at least try to break these receivables into various buckets. Larger customers, smaller customers, creditworthy customers, less creditworthy customers, or whatever the sensible way that you want to do, or you want to do it by demographics factors, do them and apply a different PD for a probability of default for different receivables rather than just testing an impairment loss for your total receivable as a whole, which I probably think would not make much sense. So you probably need to look at that on an individual basis, if that answers your question, right? So I'm going to look at further questions now. I think I can maximum take one more question because we have very limited time. So there's a question. Could you mention few examples for debt instruments for fair value through P&L from Reed? Thank you very much for that question. I mean, debt instruments at FVTPL, meaning that usually, as we understand, most equity instruments will go through fair value through P&L, where because the accounting standard setters recommend you to take the MTM gain or losses into income statement. But remember, when you are talking about debt instruments, fair value through P&L, I would talk about business model test. You look at your bond portfolio that you have in your overall investment portfolio. Ask yourself some questions. So if you have a portfolio manager or an investment manager who's managing that for you, or you yourself is managing them, you need to ask these questions yourself. Do you have bond investments? What's the purpose of keeping those bond instruments? Are you keeping those bond instruments for day-to-day trading? Are you trying to take advantage of market movements and trade on bonds? I mean, if the bonds are also, I mean, very actively traded in some markets. So in that case, if you are an active bond trader, if your portfolio manager has a set of bonds classified into a sub-portfolio, which is held for trading, I would say you classify them as a fair value through P&L. However, if you are unsure what your portfolio manager will do and he will do depending on the market changes, then you would probably go to fair value through OCI for such bonds, unless if you keep those for contractual cash flows, you classify them as HTM, which is amortized cost model in IFRS 9. So, I mean, that's again an interesting question from Reed. Debt instruments, I mean, I don't see many companies, I mean, practically to speak about it, out of the companies that I have seen or I have analyzed in the past, I don't see many companies using FTPL for bond investments. Most of the equity investments are at FVTPL, and most of the bonds are in fair value through OCI, and also with a significant portion accounted in fair value through amortized cost. So that's basically the question on FVTPL. The time is already 1 minute past the target schedule time. So thank you so much for being part of a 3-hour IFRS 9 discussion, and then I'm really amazed, thrilled, and excited to see the level of momentum and see the number of people who have registered for the program and participated over the last 3 hours. Hope you found the sessions good. And I mean, if you have any comments about my sessions, if you have any further questions, please feel free to reach out to me in my email address. And I would like to take this opportunity to thank the ACCA, Misa, and Tarun for organizing this, and a special thanks for ACCA Sri Lanka division, and a big thank you to Ruchira for you to organize this. And then finally we did this session with a great engagement with members from all over the world. So I'm excited to do this, and I look forward to seeing you in a forthcoming future session. Right, so thank you so much. Over to ACCA Misa, if you can handle and complete the session.
Thank you so much, Masudan, for this 3-hour session. It was very great. Lot of knowledge coming from you. Hope we can have such a session soon again. Thank you, everyone. We had above 1,700 registrations. Thank you so much. Thank you, Masudan. Till next time, take care.
Yeah.
Goodbye.
Thank you so much. Take care.
Take care.